Most investors think markets react to bad news the moment it appears on screen. That is usually the wrong starting point. Markets can absorb bad headlines. They do it all the time. What they struggle with is the quiet shift underneath the headline, the part that has not been fully measured yet, the part that has not made it into positioning, earnings assumptions, or inflation expectations. That is the part worth paying attention to now. Because when people hear oil disruption, they often think in a very narrow way. They think gasoline prices, maybe airline tickets, maybe a few rough days for equities. Then they move on. But that is not how a serious supply shock works when it sits near the center of global trade. The first move is visible. The second move usually is not right away. And that is where markets get caught leaning the wrong way. This is not a call for panic. It is almost the opposite. It is a reminder that by the time a story feels obvious, the easy interpretation is usually gone. What matters then is the transmission mechanism. Who feels it first, where pricing moves next, and which assets are being forced to reprice before the broader market fully accepts what changed. That is the frame I want to use here. Not fear, not certainty. Just a cleaner way to read what the market may be starting to notice. Over the past several days, the focus of the energy market has shifted back to one of the most important choke points in global trade, the Strait of Hormuz. Roughly 20 to 30% of the world's seaborne crude oil trade typically moves through this narrow passage connecting the Persian Gulf to the open ocean. The majority of that oil is shipped toward Asian importers, including China, Japan, South Korea, and India. In the last week, vessel traffic through the strait has slowed significantly as security risks increased. Several commercial shipping firms temporarily paused transit while insurers reassess coverage for tankers operating in the region. When that happens, the effect is immediate. Tankers wait offshore, ports experience congestion, and shipments are delayed even if production itself has not stopped. The market responded quickly. Brent crude oil, the international benchmark, moved sharply higher during the week as traders began pricing in the possibility of tighter, near-term supply. Energy markets tend to react fast to disruptions around choke points because transportation delays can remove large volumes of oil from the global system, even if only temporarily. At the same time, attention has turned to inventories and strategic reserves. Countries that rely heavily on Gulf imports maintain emergency stockpiles precisely for situations like this. According to public reserve data, Japan holds more than 200 days of strategic petroleum reserves, while China and South Korea also maintain large state-controlled inventories designed to stabilize supply during disruptions. Financial institutions have begun publishing early assessments of the situation. For example, analysts at JP Chase noted in recent research that prolonged disruptions in the Strait of Hormuz could tighten global oil supply materially. Their analysis frames this as a scenario-based forecast, not a confirmed outcome. Similarly, commodity analysts at Goldman Sachs have suggested that if shipping constraints persist, oil prices could rise further due to reduced short-term availability in physical markets. Again, this is presented as a conditional outlook, dependent on how long the disruption lasts. At this stage, the confirmed facts are straightforward. Shipping flows slowed, risk premiums increased, oil prices moved higher, and analysts began modeling potential supply scenarios. The market is now trying to determine whether this is a temporary logistical disruption or the beginning of something larger. When people hear about disruptions near the Strait of Hormuz, the instinct is to think about oil prices and stop there. But the price of crude is only the first reaction. The more important part is the sequence that tends to follow. Start with transportation. A large portion of global oil exports leaves the Persian Gulf through that single corridor. When vessel traffic slows, even temporarily, physical barrels do not arrive where they are expected. Refineries in Asia, particularly in China, Japan, South Korea, and India, are among the first to feel that delay because they depend heavily on Middle Eastern crude. The initial adjustment often happens in shipping insurance and freight costs. If insurers increase premiums or temporarily suspend coverage in high-risk areas, tanker operators become cautious. Fewer ships enter the region, or they wait offshore. That slows the flow of crude without requiring any wells to shut down. From there, the effect moves into refining margins. Refineries are designed to operate continuously. When feedstock deliveries become uncertain, operators may adjust runs or look for alternative crude grades from other regions, such as the Atlantic Basin. That surge increases competition for available supply outside the Gulf, pushing prices higher across multiple benchmarks, not just Middle Eastern crude. The next layer appears in energy derivatives and inflation expectations. Oil is embedded in transportation, manufacturing, agriculture, and logistics. When crude rises, it eventually affects diesel, jet fuel, and shipping costs. Those changes feed into broader pricing pressures over time. Economists often track this through energy components and inflation measures such as Consumer Price Index and Personal Consumption Expenditures Price Index. This is where financial markets start to pay closer attention. If energy prices rise meaningfully, investors begin reassessing expectations for interest rates, economic growth, and corporate margins. Energy producers may benefit, while industries sensitive to fuel costs, transportation, chemicals, logistics, face pressure. Another layer appears in currencies and sovereign policy. Countries that import large volumes of oil must spend more foreign currency when prices increase. That can affect trade balances and exchange rates, particularly for economies that rely heavily on energy imports. Meanwhile, central banks monitor inflation risks. Rising energy prices do not automatically change monetary policy, but they can influence how policymakers interpret inflation data in the months that follow. None of these reactions happen all at once. The oil price is the headline. The real story is the chain reaction that spreads outward, from shipping routes to refiners to energy markets and eventually into the broader financial system. That process is still unfolding. Energy markets have seen disruptions around the Strait of Hormuz before. The geography alone makes it unavoidable. A narrow waterway connecting the Persian Gulf to global shipping lanes means that even temporary disruptions can ripple through the market. One useful reference point goes back to the late 1970s. During the 1979 Iranian Revolution, oil supply from a major exporter fell sharply. Production disruptions, combined with already tight supply conditions, pushed oil prices significantly higher over the following year. What mattered at the time was not just the loss of barrels, but the uncertainty surrounding how long the disruption might last. Another example occurred during the Gulf War. When Iraq invaded Kuwait in 1990, oil markets reacted immediately. Prices spiked as traders attempted to estimate how much production would be removed from the global system. Once supply from other producers increased and military operations stabilized the region, prices gradually retreated. More recently, energy markets experienced a different type of shock during the COVID-19 pandemic. That episode did not involve supply disruption. Instead, demand collapsed almost overnight as transportation and industrial activity slowed worldwide. Oil prices briefly fell to historic lows, showing that demand shocks can move the market just as dramatically as supply disruptions. Those historical moments provide perspective, but they are not exact templates. Today's global oil system looks different. Production has diversified across regions, with countries like the United States becoming a major source of supply. Strategic reserves maintained by importers such as Japan and China also provide a buffer that did not exist at the same scale decades ago. Financial markets are different as well. Energy is deeply integrated into global derivatives markets, where futures, options, and hedging strategies allow producers and consumers to manage risk more actively than in the past. History, therefore, is useful for understanding how markets react under stress, but it does not dictate what must happen next. Each episode reflects a unique mix of geopolitics, supply conditions, and investor expectations. The present situation will unfold within its own set of constraints. Professionals rarely approach markets with a single prediction. A more practical framework is to outline several possible paths and then watch which one the data begins to support. Energy markets, especially when geopolitics is involved, are rarely linear. Below are three simplified scenarios that analysts currently consider when evaluating disruptions near the Strait of Hormuz. Bull case, supply tightens further. If shipping disruptions persist or escalate, then the supply of crude reaching global markets could tighten more noticeably. In that environment, tanker delays would continue, insurers would maintain elevated risk premiums, and refiners would compete more aggressively for barrels outside the Gulf region. When buyers start sourcing alternative supply from West Africa, the United States, or Latin America, the competition for those barrels typically pushes global benchmark prices higher. Analysts at Goldman Sachs have noted in recent research that prolonged disruptions in Gulf shipping lanes could place upward pressure on crude prices if inventories begin to draw faster than expected. That statement is a forecast scenario, not a confirmed outcome. Under this scenario, higher oil prices could feed into energy equities, strengthen revenues for major producers, and gradually affect inflation expectations if sustained long enough. The key condition is duration. Short disruptions rarely change long-term pricing. Persistent ones sometimes do. Base case, temporary disruption. The base case many analysts start with assumes that shipping delays eventually stabilize and that energy flows resume with limited long-term damage. If that happens, the initial spike in risk premiums tends to fade. Tankers return to normal routes, insurance markets recalibrate, and refiners resume standard procurement schedules. In this environment, oil prices may remain volatile for a period, but eventually settle within the broader range defined by global supply and demand. Strategic reserves held by countries such as Japan, China, and South Korea can also act as buffers if governments choose to release them. Many disruptions in energy markets historically fall into this category. Sharp initial reaction followed by gradual normalization once logistics recover. Bear case, demand weakens or supply expands elsewhere. The third scenario is less about escalation and more about counterbalance. If global economic growth slows, or if major producers increase output, then the upward pressure from shipping disruptions could fade more quickly. Increased production from regions such as North America or higher exports from other OPEC members could offset lost supply from disrupted routes. Research teams at J.P. Morgan Chase have highlighted this possibility in several market notes. Their analysts emphasize that energy prices ultimately depend on the balance between supply and demand. If additional production enters the market or consumption slows, price spikes may not persist. Again, that is a conditional outlook, not a certainty. The purpose of outlining these scenarios is not to forecast a single outcome. It is to recognize that markets move along probabilities, not headlines. What matters most is watching which conditions begin to appear in the data. When the market is trying to decide whether a disruption is temporary or structural, headlines become less useful. What matters more are the indicators that show how capital and policy are actually reacting. Here are several signals I follow closely. First, the US dollar index. Energy is priced globally in dollars. When oil prices rise sharply, the relationship between energy costs and currency strength becomes important. A rising dollar can sometimes moderate commodity prices by tightening global financial conditions. Weakening dollar can have the opposite effect. Watching the direction of the dollar helps explain how easily higher oil prices may translate into broader commodity inflation. Second, U.S. Treasury yields, particularly the 10-year Treasury. Bond markets tend to react early when investors begin adjusting expectations for inflation or growth. If energy prices stay elevated, bond yields sometimes move higher as markets price in inflation risk. If yields fall instead, it can suggest investors are more concerned about slower economic activity. Third, inflation data itself. In the United States, economists closely follow the Consumer Price Index and the Personal Consumption Expenditures Price Index, which is the preferred inflation gauge of the Federal Reserve. Energy costs often feed into these measures with a lag. Watching upcoming releases can reveal whether higher crude prices are beginning to influence broader consumer prices. Fourth, market positioning. Energy futures markets provide clues about how traders are responding. Rising open interest in crude oil contracts can indicate that new positions are entering the market rather than simply short-term volatility. Volume patterns can help distinguish between speculative moves and structural repositioning by institutions. Finally, physical market signals. Shipping data, tanker routes, and refining margins often reveal more about supply conditions than daily price movements alone. If crude inventories begin falling across multiple regions while shipping delays persist, that would suggest tightening supply in the physical market. None of these indicators provides a complete answer by itself, but together they help build a clearer picture of whether a short-term disruption is fading or quietly becoming something more durable. Markets move through uncertainty more often than people realize. Energy disruptions, geopolitical risks, and supply shocks are part of the landscape investors operate in. What matters is not reacting to every headline, but understanding the mechanisms behind them. Right now, the data shows a disruption in a critical shipping corridor and a market adjusting to that possibility. Analysts are modeling several outcomes, but none of them are guaranteed. So the approach remains the same. Watch the indicators, manage risk, and avoid overconfidence in any single narrative. This isn't investment advice. It's simply how I'm reading the market at this moment, carefully, patiently, and with the understanding that conditions can change faster than forecasts.